My name is Michael King. Now we're going to look at the second video about the capital asset pricing model, about how to get the beta of a stock, and then how to calculate the beta of a portfolio, where beta is a measure of the sensitivity to market risk. This is going to be sections 9.3 out of chapter 9 and 20.6 out of chapter 20 from Booth, Cleary, and Rokita. So recall that William Sharpe won the Nobel Prize in 1990 for developing this idea, the capital asset pricing model, which is a model that's used to calculate the required return on a stock based on its sensitivity to market risk, which is going to be measured by beta. So this was the way that I like to show the formula. You have the risk-free rate at a given point in time, t. You have the beta for this stock, and you have the equity risk premium, which is going to be a long-term average of what you would receive as a premium for holding stocks over risk-free bonds. The CAPM says that the required return is a function of some minimum return based on a risk-free rate plus some market premium based on how risky the stock is. So where does this beta come from? We see in the formula that it measures the sensitivity of a stock to market risk, which means non-diversifiable, or what we call systematic risk. Okay, so that's a term that we need to explain. So we're going to calculate beta by running a regression where we're going to regress a stock's returns on the returns for the market over the same period, and beta is actually going to be the slope of a fitted line. What that means by being the slope is that beta is going to be the covariance of a security's returns with the market returns. Another way of saying covariance is to say the correlation between the stock and the market multiplied by the ratio of the stock standard deviation to the market standard deviation, where standard deviation is a measure of risk. Okay, and correlation is a measure of how returns move with each other. So here's beta. This is a statistical measure. The first term shows covariance of a stock with the market over the variance of the market, which is standard deviation squared. You can break that up and it can be correlation between the stock and the market times the standard deviation of the stock over the standard deviation of the market. And we're going to see how we can use this in a moment. Let's talk about beta though. So beta, we said, measures the non-diversifiable or the market risk. But when we talk about risk, we usually talk about total risk. Now, total risk is measured by standard deviation of returns. Okay, so when we're talking about risk, we typically split it up into two parts. The part that can be diversified away by adding stocks together in a portfolio, and this part is usually called the diversifiable, the idiosyncratic, the firm specific. Notice that as we add stocks to a portfolio, that risk is being removed because two stocks don't move the same in response to overall changes in economic conditions. But what you can't remove as you add stocks is this exposure to the overall market, which we're going to call market risk, non-diversifiable risk, or systematic risk. And this is what beta is measuring. Beta is measuring the sensitivity to this market risk. So here's this regression that we talked about. Basically, we take the returns for a security A, and it could be the monthly return, could be the weekly return. You calculate them over a long period. If we're using monthly returns, we'll usually use 5 years of monthly data or 60 observations. And you would regress it against the overall market returns over those same 5 years. And you get this picture with the blue dots. And you draw a line that is the line of best fit. And the slope of that line is going to be beta. And beta is a measure of the relationship between these two. Notice that beta, or the slope of a line from statistics, can be measured using this covariance over the variance of the market, or using this correlation coefficient multiplied by the ratio of the two standard deviations. If we know that stock A has a correlation with the market of 0.9 or 90%, that stock A's standard deviation is 3.1, and the standard deviation in the market is 1.8, then we could have already calculated beta simply by multiplying 0.9 times the ratio of 2.3 over 1.8, and we would see that the beta is 1.15. This is the sensitivity of this stock A to the overall market. Let's look at another calculation. Here we have returns weekly for the stock of BlackRock, which is a publicly owned investment manager, Centene Corp, which is a healthcare company, and a ETF or exchange traded fund that tracks the S&P 500, and this one managed by Vanguard. Notice that in the first week here, you can see that BlackRock stock was up that week, Centene's was up even more, and the market was actually down. So you can see that these stocks are not moving one for one with the market. You can see there's different combinations. Is there a pattern? Well, that's where regression comes in. Let's look at a regression of BlackRock on the market. If you were to graph BlackRock's returns weekly against the market weekly from 2012 to 2017, you would see that there's actually a correlation of around 0.794 or 79.4% between their two returns. Now you would see also that BlackRock's standard deviation returns was higher at 2.9 versus the overall market at 1.6. And if you fit this line, you would see that the slope is 1.44. Now you could have calculated this simply by taking that correlation coefficient and multiplying it by the ratio of the two standard deviations to get the same beta. Okay, that's what a regression is effectively doing when it creates that fitted line. Notice that the line isn't perfect, however, that those blue dots are clustered around the line, but they don't lie exactly on the line. That's because this is very imprecise. And remember that we're looking at historical relationships, not the future. To recap, beta is the slope from a regression of a stock's returns regressed on the market returns, and it measures the sensitivity of the stock return to the market return. What does that mean? Betas tend to go from 0 to 2. If the beta is 1.5, then when the market goes up 10%, the stock will go up by 1.5 times that, or 15%. Conversely, if the stock market goes down 10%, this stock will be more volatile and will drop by 15%. When the beta is 1, a stock will go up and down at the same amount as the market. And when a beta is 0.5 or half, it'll have half the sensitivity to market movements. So when the market's up 10%, the stock's up 5. When the market is down 10%, the stock's down 5. The market is made up of all the stocks, so you won't find a beta of 0 unless you choose another asset that is not part of the overall stock market. Okay. We don't estimate betas using daily returns. They're too noisy and too unstable. So we will either use 5 years of monthly returns, or we'll use 2 years of weekly returns when doing these estimates using regressions. You'll notice, however, that betas are unstable, even though they're estimated over long periods of time. If you pick different time periods, you can see that they change. Here, for example, look at the middle of the table, Barrick Gold, gold producer. If you measured its beta in 2011, it was very low at 0.46, half the market. But in 2014, it was equal to the market, and so on for the other companies. So now that we know how to calculate the beta of a stock, we can calculate the beta for a portfolio of stocks. We simply have to take the weighted betas of the individual stocks. Okay, so if you have 3 stocks, you would take their weights multiplied times their beta, and that would be the beta of the portfolio. Okay, so let's assume you have a stock A with a beta of 0.6, a stock B with a beta of 0.8. If you hold 50% of each, what is your portfolio beta? It's simply the weights times the betas. It's going to be 0.5 times the beta of 0.6 and 0.5 times the beta of 0.8, and it's going to be 0.7. Does that make sense? Yes, because clearly the portfolio is going to be in between if it's a combination of both.